If you wake up 6 months from now and silver is no longer trading anywhere near 77.41, you will remember this moment. You will remember whether you acted with clarity or hesitated in uncertainty. As of today, Sunday, 15th February 2026, silver is sitting at a level that looks calm on the surface, but beneath that calm, pressure is building from directions most investors are not even watching. And when pressure builds quietly in financial markets, the release is rarely subtle. Right now, you are either holding silver, considering adding to a position, or debating whether you missed the opportunity altogether. The truth is the opportunity has not passed. It is forming, because 77.41 is not just a price. It is the intersection of sovereign debt expansion, monetary tension, industrial transformation, and tightening physical supply. It represents a balance point between opposing forces that cannot remain in equilibrium forever. To understand why this level matters, we do not need to revisit ancient monetary history. We only need to examine what unfolded over the past year. Throughout 2025, silver did not explode upward in a speculative frenzy. It climbed methodically. It repriced steadily as global demand exceeded supply for the fifth consecutive year, according to data from the Silver Institute. That cumulative deficit materially reduced above-ground inventories and tightened available float. These shortages did not appear overnight. They were the result of years in which mine production failed to keep pace with expanding consumption across financial and industrial channels. As 2026 began, silver had already broken above resistance levels from the early 2020s that many analysts once labeled unrealistic. What seemed improbable 18 months ago became reality. At the same time, macroeconomic dynamics in the United States continued reshaping capital allocation decisions worldwide. The Congressional Budget Office projected a federal deficit exceeding $1.5 trillion for fiscal year 2026. National debt surpassed $36 trillion early this year. Interest payments alone now absorb a larger portion of federal spending than defense. That fact alone forces a serious conversation about sustainability. Debt expansion at this scale cannot be separated from currency credibility. When sovereign liabilities grow faster than economic output, governments historically rely on monetization, whether directly through money creation or indirectly through policies that suppress real yields. Both approaches dilute purchasing power over time. Across centuries of economic cycles, precious metals have served as beneficiaries when confidence in fiat systems erodes. The Federal Reserve enters this year navigating a narrow corridor. Inflation has moderated from its pandemic-era peaks but remains stubbornly above the 2% target. Core personal consumption expenditures, inflation, the central bank's preferred gauge, has hovered in the upper 2% range through late 2025 and into early 2026. That persistence prevented the aggressive rate-cutting cycle many market participants expected. Instead, policy remains moderately restrictive. Short-term interest rates are elevated. Money market funds still offer yields above 4%. Treasury bills compete directly with non-yielding assets. This creates a tension for silver. Higher real yields increase opportunity cost. Yet inflation's refusal to return decisively to target validates concerns that the post-pandemic economic environment differs structurally from the low inflation decade that preceded it. Silver has responded not by collapsing, but by consolidating. And consolidation at elevated levels is rarely meaningless. When a commodity rallies and then trades sideways, it is digesting gains. It is compressing volatility. Beneath a narrowing range, buyers accumulate and sellers test conviction. Energy builds quietly. Another powerful influence is the United States dollar. Early 2026 has seen relative dollar strength supported by higher American yields compared to many global counterparts. A stronger dollar makes silver more expensive internationally, acting as a temporary headwind. But currency strength is rarely permanent. Several major economies have gradually diversified reserve holdings away from dollar-denominated assets. The freezing of foreign reserves in prior geopolitical events highlighted risks of concentration. China continued adding to gold reserves through 2025 and into 2026. Reports suggest sovereign accumulation of silver as well, though with less public transparency. The expanded BRICS bloc continues discussing alternative settlement mechanisms that reduce reliance on the dollar for bilateral trade. None of these shifts dethrone the dollar overnight, but incremental diversification compounds over time. Should dollar strength soften, silver would benefit in two ways simultaneously: enhanced affordability for international buyers and heightened domestic interest in inflation hedging. The gold-to-silver ratio adds another dimension. As of early 2026, the ratio remains elevated compared to long-term historical norms. That indicates silver is undervalued relative to gold on a proportional basis. Historically, precious metals bull cycles follow a familiar sequence. Gold moves first, Silver lags, then silver accelerates sharply during the latter stages of the cycle, often outperforming in percentage terms. Gold reached new all-time highs in 2025 and has sustained strength into this year. Silver's relative underperformance during that period mirrors historical patterns rather than signaling weakness. When momentum shifts decisively, silver's thinner liquidity and higher volatility can amplify gains. Physical market data reinforces tightening conditions. Vault holdings across major bullion hubs have trended lower over the past 2 years. Registered inventories available for delivery against futures contracts have declined. When physical metal exits the system faster than it is replenished, paper pricing and tangible supply converge. Major mints reported elevated demand throughout 2025 and into early 2026. Retail interest has been steady rather than speculative. That consistency matters more than frenzy. Sustained withdrawal of physical ounces reduces float gradually and persistently. Exchange-traded funds have also recorded modest inflows, suggesting renewed institutional participation. Supply constraints amplify demand shifts. Most global silver production occurs as a byproduct of mining for copper, zinc, and other base metals. Higher silver prices alone do not immediately trigger increased output. Developing primary silver mines requires years of permitting, financing, and construction. In the United States, production remains concentrated in a limited number of operations across states such as Nevada, Idaho, and Alaska. This structural inelasticity means supply cannot scale rapidly in response to demand spikes. When modest increases in consumption meet rigid production capacity, price adjustments can become disproportionate. Industrial demand remains a foundational driver. Advanced solar technologies, including heterojunction and tunnel oxide passivated contact cells, require greater silver intensity than earlier designs. Domestic solar manufacturing expansion continues, supported by policy incentives enacted earlier in the decade. Electric vehicles incorporate approximately 1 to 2 ounces of silver within electrical systems and charging infrastructure. Global sales continued rising in 2025 with projections for further growth. Telecommunications infrastructure expansion, particularly 5G networks, relies on silver components in connectors and circuit boards. When persistent physical deficits, supply rigidity, industrial expansion, fiscal strain, sticky inflation, and an elevated gold-to-silver ratio converge, the structural backdrop appears constructive. That is the bullish interpretation at 77.41. But markets are rarely one-sided, and before drawing conclusions, it is essential to examine the counterforces that could restrain or delay silver's next move. Because equilibrium at this level is not accidental. It reflects tension, and tension in financial markets never remains unresolved forever. The most immediate counterforce pressing against silver today is monetary policy. As long as the Federal Reserve maintains a restrictive stance, real interest rates create measurable resistance. When investors can earn more than 4% in money market funds or short-term treasury instruments, the opportunity cost of holding a non-yielding asset becomes tangible. Capital allocation decisions are rarely emotional at institutional levels. They are arithmetic. Federal Reserve leadership has consistently emphasized data dependency. Each employment report, inflation reading, and growth estimate shapes expectations in real time. As of mid-February 2026, the labor market remains historically resilient. The unemployment rate sits near multi-decade lows. Wage growth has cooled from peak acceleration, but remains elevated compared to pre-pandemic norms. That resilience gives policymakers flexibility to maintain restrictive policy longer than commodity bulls might prefer. Yet labor markets are lagging indicators. By the time unemployment rises meaningfully, underlying economic deceleration is often already advanced. Leading indicators present a more complicated picture. The yield curve has signaled caution. Manufacturing surveys have shown uneven momentum. Credit conditions have tightened incrementally. None of these signals alone confirm recession, but collectively they introduce uncertainty. If economic momentum slows more visibly in the second quarter or into the summer of 2026, the Federal Reserve could pivot toward easing sooner than currently priced. Precious metals historically respond not at the moment of policy change, but at the moment of expectation shift. Markets anticipate before they react. When investors begin pricing future rate cuts, the dollar often softens and real yields compress. That environment removes a primary headwind restraining silver. The United States Treasury market introduces another dimension. Financing deficits above $1.5 trillion annually requires sustained demand for government bonds. If demand weakens relative to issuance, yields must rise to attract buyers. The cause of rising yields matters. When yields increase because growth expectations improve, precious metals may struggle. But when yields rise because investors demand compensation for fiscal risk, that dynamic can support hard assets. Debt exceeding $36 trillion alters perceptions of long-term sustainability. Interest payments consuming a larger share of federal spending than defense reinforces that perception. Credit rating agencies have previously adjusted outlooks and ratings in response to fiscal trajectory. While ratings changes do not immediately alter market behavior, they signal evolving sentiment. A disorderly bond market episode driven by supply concerns rather than deliberate monetary tightening could reshape capital flows rapidly. In such scenarios, investors often seek tangible stores of value. Silver historically participates alongside gold during periods of sovereign stress. China remains central to the industrial demand equation. As the largest global consumer of silver for fabrication, China's economic performance influences baseline consumption. Structural adjustments in its property sector, combined with stimulus efforts from the People's Bank of China, continue shaping growth trajectories. If Chinese industrial production accelerates beyond expectations, silver demand would likely strengthen correspondingly. Conversely, deeper economic contraction in China could temporarily dampen industrial usage. However, renewable energy infrastructure remains a strategic priority independent of cyclical fluctuations. Solar manufacturing capacity expansion persists, and advanced photovoltaic technologies continue requiring substantial silver input. India represents another significant driver. Cultural affinity for precious metals combines with rapid industrialization and demographic expansion. Silver imports surged in 2024 and remained elevated through 2025. As India's electronics, renewable energy, and manufacturing sectors expand, structural demand strengthens across multiple channels. Geopolitical volatility overlays these economic dynamics. Trade tensions, regional conflicts, and shifting alliances contribute to persistent uncertainty. Historically, uncertainty channels capital into safe haven assets. Gold typically absorbs the majority of that flow, but silver often benefits as an accessible alternative when gold prices exceed thresholds that deter smaller investors. With gold trading above $2,500 per ounce, silver becomes the practical entry point for many participants seeking precious metals exposure. During previous cycles, once gold established new highs and attracted mainstream attention, silver frequently delivered accelerated percentage gains in subsequent phases. Retail market behavior has matured compared to prior speculative episodes. Demand for physical silver products remains consistent rather than frenzied. Online bullion dealers report steady sales of 1-ounce rounds, 10-ounce bars, and sovereign-issued coins. When physical metal leaves the tradable system, it reduces available supply incrementally but persistently. Exchange-traded funds have experienced modest inflows, suggesting renewed institutional allocation. Institutional participation tends to be more durable than leveraged futures trading. That stickiness contributes to stability during consolidation phases and can amplify momentum once breakouts occur. The futures market presents both opportunity and risk. The Commodity Futures Trading Commission's Commitments of Traders reports reveal positioning among leveraged funds. Elevated net long exposure increases vulnerability to liquidation if negative catalysts emerge. Futures-driven sell-offs can temporarily disconnect price from physical fundamentals. Such dislocations, while uncomfortable, have historically created favorable accumulation windows for investors focused on long-term structural dynamics. Short-term volatility does not negate persistent supply deficits or industrial demand trends. Substitution risk remains a commonly cited headwind. Manufacturers continually explore alternatives to manage input costs. Copper, aluminum, and advanced conductive materials receive research investment. However, substitution is gradual. Product redesign, retooling, and qualification processes span years rather than months. Silver's superior conductivity and durability limit the feasibility of widespread replacement. Supply rigidity amplifies demand sensitivity. Because most silver production is a byproduct of other metals, output does not respond rapidly to price signals. Developing new primary silver mines involves lengthy permitting and capital investment cycles. In the United States, production remains concentrated across limited geographic regions, constraining flexibility. Price compression around 77.41 reflects equilibrium between these opposing forces. Consolidation narrows trading ranges, reduces volatility, and fosters complacency. Yet, compression phases historically precede decisive breakouts. When momentum returns, it often does so with speed that surprises participants who mistook stability for permanence. Scenario analysis clarifies positioning. In a bullish case, inflation proves persistent, the dollar weakens, and rate cuts begin earlier than expected. Silver's inherent volatility could drive rapid upside. In a neutral case, consolidation continues while deficits accumulate quietly beneath the surface. In a bearish case, a deflationary shock triggers initial declines before stimulus responses eventually reignite demand. Across all scenarios, asymmetry remains central. Severe downside historically proves temporary as policy responses emerge. Upside during structural bull phases can be substantial and sustained. At 77.41, silver embodies tension rather than resolution. Monetary policy, fiscal expansion, industrial transformation, and geopolitical uncertainty intersect at this level. Compression cannot endure indefinitely. The breakout will come. The catalyst may surprise. Preparation determines whether participation precedes momentum or follows it. When you strip away daily headlines and short-term volatility, the silver story in 2026 becomes less about speculation and more about structure. Markets can drift sideways for months, but structural imbalances do not disappear. They accumulate, and when they accumulate long enough, repricing follows. The global financial system is operating under debt burdens that would have been considered extreme in previous generations. The United States has surpassed $36 trillion in national debt, with annual deficits projected above $1.5 trillion. Servicing that debt absorbs an increasing share of federal revenue, with interest payments now exceeding defense expenditures. That arithmetic cannot be ignored indefinitely. Debt expansion itself does not guarantee inflation. But when debt growth consistently outpaces economic growth, policymakers face limited choices. They can impose austerity, which is politically unpopular and economically contractionary. Or they can rely on policies that ease the burden through monetary accommodation and financial repression. History shows that governments frequently choose the latter. Since 2020, purchasing power erosion has already been observable. Even though inflation has moderated from peak levels, prices remain structurally higher across essential categories. Core personal consumption expenditures inflation continues hovering above the Federal Reserve's 2% objective. This persistence complicates the policy path forward. If inflation remains elevated while growth slows, the Federal Reserve confronts a delicate balancing act. Cutting rates prematurely risks reigniting price pressures. Maintaining restrictive policy for too long risks economic contraction. Transitional periods like this often create fertile ground for precious metals because uncertainty undermines confidence in traditional asset classes. The dollar's role amplifies these dynamics. As long as American yields remain relatively attractive, the dollar maintains strength, but currency dominance depends on perception as much as on rates. Incremental diversification by global reserve managers away from dollar-denominated assets reflects evolving geopolitical calculations. China's continued accumulation of gold through 2025 and into 2026 signals long-term strategic positioning. Discussions within the expanded BRICS bloc regarding alternative settlement systems further highlight gradual shifts. A decisive dollar weakening would likely accelerate silver's upward movement. It would enhance affordability for international buyers and reinforce inflation hedging domestically. Conversely, sustained dollar strength could delay breakout timing without eliminating structural pressures. Industrial demand remains the most powerful stabilizing force beneath silver. Solar manufacturing, particularly advanced heterojunction and tunnel oxide passivated contact technologies, requires significant silver intensity. As renewable energy deployment expands globally, silver becomes embedded within the infrastructure transition. Electric vehicles incorporate approximately 1 to 2 ounces of silver in electrical systems, battery connections, and charging networks. Global EV adoption continued climbing in 2025 and projects further expansion through 2026. Telecommunications infrastructure expansion, including 5G deployment, relies on silver components in connectors, circuit boards, and switching systems. When industrial usage represents the majority of annual demand, silver's floor strengthens. It is no longer dependent solely on investment sentiment. Fabrication needs persist, regardless of short-term market volatility. Physical inventory trends reinforce tightening conditions. Registered stocks available for delivery against futures contracts have declined from earlier peaks. While a full-scale delivery squeeze remains a low-probability event, persistent inventory reduction increases sensitivity within price discovery mechanisms. Retail behavior adds a psychological layer. Consistent purchases of 1-ounce rounds, 10-ounce bars, and sovereign coins remove physical metal from circulation. That metal is rarely resold quickly. Exchange-traded funds, meanwhile, provide institutional access and introduce longer holding periods. Risks remain. A sharp global recession could suppress industrial demand temporarily. Futures market leverage could amplify volatility during risk-off episodes. Substitution research could gradually reduce silver intensity in select applications over extended timelines. No investment thesis exists without counter-arguments. Yet the asymmetry remains compelling. In deflationary shocks, policymakers historically respond with monetary expansion. Stimulus measures often follow contraction. Precious metals frequently rebound strongly in those environments. Downside risk tends to be cyclical. Upside potential during structural repricing phases can be swift and substantial. Position sizing therefore becomes critical. Allocating between 5 and 15% of a diversified portfolio allows exposure without overconcentration. Within that allocation, diversification across physical holdings, exchange-traded funds, and select mining equities balances liquidity and leverage. Physical silver eliminates counterparty risk but requires secure storage. Exchange-traded funds provide flexibility but depend on custodial structures. Mining equities offer amplified upside yet introduce operational and jurisdictional variables. No single vehicle is universally superior. Strategic allocation matters more than instrument selection. Dollar-cost averaging offers discipline. Investing fixed amounts at regular intervals reduces emotional pressure tied to entry timing. Volatility becomes a mechanism for accumulation rather than a source of anxiety. The deeper philosophical question remains unavoidable. Is the current fiscal and monetary trajectory indefinitely sustainable? Governments continue operating with structural deficits. Political incentives frequently favor spending over restraint. Purchasing power erosion since 2020 is measurable. Whether stabilization occurs without further monetary accommodation remains uncertain. Silver functions within this context as insurance rather than speculation. It represents tangible scarcity in a financial system capable of digital expansion. That scarcity becomes meaningful when evaluating long-term wealth preservation strategies. At 77.41, sentiment appears balanced. There is no widespread euphoria driving reckless buying. There is no pervasive despair driving forced liquidation. Historically, such neutrality often precedes decisive movement. Compression phases conceal energy accumulation. The breakout, when it occurs, may appear sudden. The catalyst could be a monetary pivot, fiscal stress event, currency shift, industrial demand surge, or geopolitical shock. Markets rarely announce inflection points in advance. Preparation, therefore, becomes the rational response. Study the data, understand the drivers, size allocations responsibly. Accept volatility as inherent. Patience distinguishes investors from speculators. Every structural force examined here points toward strengthening fundamentals. Physical deficits persist, industrial demand expands, sovereign debt accumulates, inflation remains sticky. The gold-to-silver ratio suggests relative undervaluation. None of these elements guarantee a precise price target or timeline. Financial markets resist linear extrapolation, but probability distributions shift as pressures compound. The balance of evidence favors higher prices over multi-year horizons rather than sustained contraction. As of Sunday, 15th of February 2026, the silver story remains in progress. Policy decisions, fiscal developments, technological adoption, and geopolitical events will continue shaping outcomes. Investors who approach this environment with discipline and perspective position themselves ahead of reactionary flows. Compression will not last indefinitely. When resolution arrives, speed may surprise those who mistook stability for permanence. Participation before clarity often proves more advantageous than chasing after momentum. Financial education remains the highest return investment available. Verify information independently. Evaluate risk tolerance honestly. Construct allocations aligned with long-term objectives. Silver does not demand certainty. It demands conviction grounded in structure. And at 77.41, structure is exactly what makes this moment significant.